So the question centers around capital gains tax. Now, capital gains tax, and please forgive me, SARS, for what I'm going to say now, but capital gains tax is one of those taxes that I always think like, flip it, man. The one thing in life that gives us joy is some capital gain. But we obviously taxed on that, but we'll pay it because, pay taxes as they are due. That makes you sleep sound at night. But when you sell a property, obviously, there are a few tricks, and there are a few tricks in the industry out there, conversations, how people are doing things. I'm not a tax expert in any way, shape, or form. I barely know the upside and downside of a calculator. So you know how I feel about numbers. Luckily, we have you. But I hear things about tricks and ways of doing things around capital gains tax, transfer duty as well. And I think we'll tackle that one next week. But capital gains tax specifically, and I immediately think, oh my goodness, this sounds like a take the front door off and say you're doing maintenance instead of doing an eviction. So I obviously translate everything back to evictions. It doesn't sound right to me. What are the legal and the fair ways to limit capital gains tax? What should you pay? What shouldn't you pay? How can you get around it? And where does the take the door off instead of doing an eviction situation lies?
So going to that analogy, it's quite funny, and everyone asks around that analogy, but unfortunately SARS is a much worthier opponent than some tenants are. So yeah, there's a lot of stuff that you can do that are tricks in nature, but remember the difference is SARS, if SARS picks it up, because there's also that element of institutional memory. So you think it's this big corporate, you're a number, they're never going to remember you, but there's patterns. So if you start whatever, you have certain claims that you're submitting every month and it starts becoming a pattern, SARS is going to start asking questions and you're going to show up on their radar. So that's already the first thing that you need to bear in mind. One person's issue with capital gains or income tax or VAT looks very different to another person's issue simply because of past conduct. So it's not fair in the sense where everyone gets to do the same thing. SARS does remember. So that's the first thing that you need to bear in mind. SARS remembers. Now, capital gains. So effectively, what capital gains is, you bought the property for whatever, 500 Rand, you sell it for 1,000 Rand. Logically, there's a capital gain of 500 Rand. It's quite literally as simple as that. You bought it, you sold it, the difference is a gain, right? Now, obviously, this is where the legalities start getting involved. Like, what did you really buy it for? Is it just the purchase price? Is it the purchase price plus, maybe the estate agent's commission? Maybe what about transfer fees? If you as the seller paid the transfer fees? What if you renovated the property and part of the gain was actually the fact that you renovated the property? So if you spent 200,000 Rand renovating the property and now there's a gain of 200,000 Rand, you shouldn't be paying tax on it because you actually spent that money to increase value. And so we look at that and we call it base cost, right? Base cost is basically what the lower amount is, what you bought it for with renovations, with estate agents, architects, lawyers, all of that. And then we look at the purchase, at what you sold it for. Now, over here, when you sell it, you can also take certain costs into account. The difference between these two figures is what your capital gains is, right? Simple as that. Now, I'm not going to go through the technical aspect of the maths on capital gains, companies versus natural persons versus trust, because I think that's a conversation all on its own. So this question to me sounded more along the lines of, how do I reduce the capital gain liability? So that's already hint number one. Make sure your base cost is done properly. Hint number two, if you haven't actually bought the property yet and you're thinking of this for future, eventually when you sell a property you haven't yet bought, then your structuring becomes paramount. But I speak about this all the time. You need to buy it in the right structures and do everything properly so that you pay as little capital gains as possible. And that's a conversation for another day. Now, where I start worrying is when people start manipulating prices, and you go, well, SARS doesn't know, so I'll sell it for 2 million as opposed to 3 million, and who'll know any better? again, remember SARS is institutional memory. Number one, SARS can ask you for valuation right now on the spot. Properties especially have very easy desktop valuations. So anyone with a username and a password can log in onto Lightstone and do a valuation on the property. So getting desktop valuations is super easy. Then there's municipal valuations that SARS can also compare it to that they have access to. And stuff like that gets flagged very quickly. So unreasonable manipulation, well, manipulation by its very nature is unreasonable, but unreasonable dictation of market value is going to be a problem. You cannot sell a 3 million rand asset for 2 million rand unless you've got proper justification for doing so. And there's rarely any justification that would just reduce value like that. There's normally other things to bear in mind. So just bear in mind, it's very easy. A second thing, even if you do get away with it, SARS can audit you at any point. So you've got 5 years where you need to keep the records where SARS can raise an additional assessment. So if they see that there's been a mistake, they can come after you. So now you sit with this on your back for 5 years. On top of that, if you're looking at fraudulent or negligent conduct, the 5 years rule doesn't apply. So SARS has as much time as they want to reopen this if it turns out that you fraudulently represented to them one price when it wasn't in fact that price. And remember, again, institutional memory. So everything's fine. You do something like this in a couple of years' time, you try to pull something else off, SARS suddenly gets a wake up as to the type of nature or the way that you do things. And now they start poking around your portfolios and all of this, and they start finding issues. So it never ends. So it's one of those things where rather do it right. There's ways of saving tax, but do it the right way. So for example, where we sometimes help our clients is if they're running businesses or something from the properties, there's certain things that can be taken into account that can reduce the value of the property and rather sell things as assets, because we have a lot of clients that just sell and they include everything all in one, and they don't bear in mind that if you divide it into smaller components, there's some components aren't taxed the same as other components. So if it's businesses, you look at the debts. The debts get sold separately. The property gets sold separately. Movable assets get sold separately. Everything gets sold differently because that will impact how your tax is calculated. And that's obviously legitimate. And this was actually a criticism that it was levied against attorneys by some tax practitioners the other day, where we sell businesses, we go out and draft contracts and go, buyers are going concern. Not understand putting a net asset value to it, and that's not actually the right way of doing it. We miss a very crucial part. That tax doesn't look at it as a net asset value of all these assets. They look at it individually. They want to know what is applied to what, because in 5 years' time there's going to be a capital gains on this, but not on this. Over here there should be income tax. Here there's VAT implications. Here there isn't VAT implications. So from a capital gains perspective, best way to play around with the price is try consider what you actually are selling, then the market value, and whether this is realistically the market value. So one last point where I see where people go, well, it's close enough, so maybe SARS wouldn't pick it up, and then we've got a private agreement between myself and the purchaser where I get something else on the back end. If that amount on the back end isn't justifiable from a commercial perspective. So we've had cases, for example, where renovations had to be done to the property or something like that, and there was private agreements between the parties. But typically speaking, if you're selling a property for 2 million and now you've got some strange acknowledgement of debt for another 200,000 from a purchaser, something's not right there. If they don't owe you the money for anything, then theoretically speaking, if this gets picked up, you're going to get into trouble.
And you're going to get audited. And there's obviously a risk, Bruno, there of actually the criminal offense, right? If it fraud, and it's not just like a slap on the wrist, it's like a orange overall.
Yeah. No, exactly. That's why it's so important to structure the deals properly, consider value, because again, it happens with properties all the time. People buy and sell, And then, there's still renovations that need to be done. And maybe somebody made a down payment and tried to pay the municipality on behalf of the seller, or the seller did something on behalf of the purchaser that now the purchaser owes them money, but they don't draft it properly. They just kind of throw it all into this, this contract, and there's no proper understanding. So when you go to SARS with capital gains, now you need to try and unbundle this. Rather, if there are any issues where you've got concerns and there's other transactions happening in the background, rather try bundle it properly so that it makes sense. And when you go and actually account for it, you say, yes, this is the value of the property. This was the value of certain renovations. They still owed me money because I made this payment on their behalf because they couldn't afford to pay it. So it's not part of the purchase price. Please bear that in mind. And it's the same as if you look at sheriff's auctions, same thing. Because you're paying the clearance figures, the purchaser's paying the clearance figures and not the seller. In cases like that, the consideration is still, well, is that part of the purchase price? Is that part of the consideration of the property, or isn't it part of the consideration? You need to bundle it properly and actually have the contract drafted to exclude it if you need to exclude it.
That's very interesting. Can I ask you a question? Well, I thought about this one. Say, for instance, you have a property, and Shane, we are constantly busy with renovations and maintenance and stuff. And say, for instance, you do things to add to the value of the property. For how long would that be a valid consideration? Say, for instance, you're holding a property, it's your primary residence. I know, but then you anyway out of
the 2 million,
transfer duty
2
thing.
million.
Okay, so say it's not a primary residence, you have a rental property, but you love the thing, you've had him for 20 years. Your tenants, as they come and go, you do a bit of maintenance, but you do renovations. For how long can you carry the cost that you spend on the property as a deduction on capital gains? I'm so sorry. I'm sorry to our viewers. I'm hijacking him now for my own little free legal advice.
On the first note, because something I forgot to mention, primary residences, there's a 2 million rand exclusion, which basically means that the first 2 million rand of capital gains, you don't have to pay tax on if it's your primary residence. Now, sometimes the issue comes in where it's multi-use, where you've got your primary residence and a tenant or like a flat or something like that. In that instance, SARS typically tends to apportion it. And so the value of the property and goes, okay, great, you can get this amount off because it's your primary residence, but over here there is a real capital gain because it was an investment property. So that's just the first thing to bear in mind. So call it a trick. If you're structured properly and the property is in your personal name, so that's not great for many other reasons aside from the 2 million rand exclusion, where if it's in your personal name, you can avoid the capital gains. And then to answer your question, there is no so first of all, right, the expenses need to be categorized as either revenue in nature or capital in nature, right? That's typically how you tell whether you're going to deduct it from income tax or whether it's a capital gains issue. Now, if you're just doing maintenance to a property, that's normally an expense. So if it's an investment property, it's just an expense. So you're doing it so you can have a tenant and you can make money. So they constantly need the same things fixed and you're just going to keep doing it. So that's very revenue. You can expense that against an income. So what people don't realize is expensing is better than having it as a base cost for capital gains, because your tax on your normal income tax is a lot higher than your tax on capital gains. Depends on the structure, but that's typically the rule of thumb, right? And again, I'm not going to go into how the things are calculated, so take my word for it. So getting a deduction from your normal income tax is cheaper. So a lot of the stuff, if you can call it revenue in nature, it gives you that immediate cash flow benefit. Now, long term, if it's capital in nature, so if you build rooms, if you change the dynamics of the house, like improve it somehow or another, it's specifically for improvements, that's capital, because that's a long-term thing. You're doing it so that you can better the income that you're going to get from it. And because that's because it's that improvement, you're supposed to keep that proof for years and years and years. So even if it's like 70 years down the line, you bought the property for 20,000 Rand and you guys built a massive structure on it worth at that time $1 million Rand, in 30 years time you're still going to need that, because you're going to need to prove to SARS what you bought it for and the improvements that you did on it, but not maintenance. And that's a very big distinction that you need to keep in mind, because it'll tell you exactly where you need to assign those expenses.
That's awesome. That was fun. Thank you, Bruno.
Pleasure.